Hello everybody, welcome back for another session for the CISI Level 2 Fundamentals of Financial Services qualification. This session we are on number 11, so we are about halfway through the programme and we're going to be looking at the benefits and risks of share ownership. So this is the second part, joined to the last session that we looked at where we focused on certain benefits to shareholders. I'm joined by two special guests again today. So we have two different people with us today. So I'd just like to introduce Anisha Popat, who is an investment services at Fidelity, and also Lushan, who is a senior investment consultant at Mercer. Welcome to you both. Thanks very much for joining us for this session. Anisha, could you introduce yourself for us first? Just tell us a bit about what you do, who you work for, and how you got to where you are, please.
Yeah, sure. Thanks for having me. So, yeah, my name's Anisha Popat. I work at Fidelity International. It's an asset management company based in the City of London. And Fidelity offers products and services to help investors manage their money. So things like pension funds and ISAs. And I work as the head of investment management services. And my role involves working across the business to make sure we have the right governance in place and we think about risk and controls to make sure that we look after our clients' money. I'm also responsible for looking after around 60 people globally who provide support to our investment team. And in terms of how I got here, I went to university after school. I did an economics degree. And when I finished, I had no idea what I wanted to do. I definitely did not know anything about finance. And I managed to get a job by complete accident in doing a data entry job at a bank in Canary Wharf. And so when I joined there, I learned a little bit more about finance and asset management in particular, and I found myself soon applying for jobs. And I applied for one at a company called Capital International, and I worked there for 3 years. And I actually worked in the Singapore office for a year of that. And after that, I moved to Fidelity, and 13 years later, I'm still here.
Excellent. So you've had a taste of sort of working internationally overseas. What was that like?
Oh, it's great. Different cultures, the food, learning lots of different things about how companies work across the globe is really interesting. So I've worked in Asia quite a lot, mainly in Hong Kong now rather than Singapore, but I continue to get some traveling outside of COVID, but hopefully we get to travel again in the coming months.
Fantastic. So, thanks very much, Anisha. Thanks for joining us today. So, Lushan, if you would extend the same courtesy to us and just tell us a bit about yourself, what you do, where you work, and how you got there, please.
I will do. Thank you, Matthew. And hi, everyone. It's great to be here. My name is Lushan, and I'm a senior investment consultant at Mercer, as you can see on the slides. I've been at Mercer for 8 years. Now, Mercer, you might not have heard about before. It's not a household name, but we are one of the largest consultancies across the world. We're part of a much bigger conglomerate called Marsh & McLennan, which aside from Mercer has other firms, for example, Oliver Wyman and Marsh, which also provide different consulting services to insurance companies and management consultancy as well. At Mercer, I'm based in our London office. So unfortunately, unlike Anisha, have not had the privilege of working abroad, but definitely something that I would very much like to do. My role is to provide investment advice to UK institutional investors. And by that, we mean essentially UK defined benefit pension funds, and those are the clients I serve primarily. Now, it might be new to some of you, but actually UK pension funds are some of the largest investors we see in the UK financial market, even though they're not necessarily the names you hear on FT headlines every single day. So my role as advisors to these pensions funds is basically to provide advice on a wide range of investment matters, that ranges from things like investment strategy. So, for example, what should the split between different asset classes, equity, bonds, and property, hedge funds, etc. What should the split be to these different type of asset classes? To how will we build a portfolio for a particular type of asset class? So for an equity portfolio, what should that look like? How many managers would you have? What kind of exposure would you have to different geographical tilts or different sectors, etc.? The split between sort of more passive approach to management, so where you very much leave it to tracking an index, or do we want very high conviction, very concentrated active strategies, for example? So there's lots of considerations in those, as well as just simple implementation. The client wants to make a change to the portfolio, we help them make it happen, to ongoing monitoring, how to check how their managers, including the likes of Fidelity, are doing on a regular basis, what their performance is like, are they charging the right fees, are their people changing, there's something we should be concerned about, etc., etc. So a very varied and dynamic role, and I do enjoy it very much. I started my career actually as an actuary at a firm that is now known as Willis Towers Watson, which is one of Mercer's main competitors. So I am an actuary by trade, although I try to change the traditional image of actuaries as dull and boring. There's lots of us who are nothing like that. So if any of you consider an actuarial career, don't let the image, the traditional image, put you off. But actually, I don't actually have a finance or academic background. And after school, I did a degree in chemistry, simply because chemistry was my favorite and best subject at school. I didn't think too much about what I wanted to do after university, but very much enjoy my chemistry degree. A science degree gives you so many skills for a variety of jobs, the technical, analytical skills, the work ethic, because science degrees are not easy ride. But during my university time, it was right in the middle of financial crisis, 2008, 2009. It was when I was halfway during university, and that really piqued my interest in finance and a career in finance and investment instead of a career in chemistry. So I did internships in investment banking, and after that I took up a job in actuarial consulting, and then from there moved to investment consulting at Mercer.
Brilliant. Thank you very much to you, Lushan, and thank you very much, Anisha, as well. Just a question, because obviously you are both ladies, and I mean, we talk a lot about kind of improving diversity within financial services and things like that. How have you both found kind of your getting to where you are? Has that been a smooth process, smoother than you thought? How do you find, in terms of diversity within the areas that you work in, are some of the firms still stuck in kind of the Middle Ages, or do you find that it's much more modern now and the opportunities are there for no matter whether you're a man, woman, wherever you're from, whatever your background?
I'll go first.
Yes, so, sorry.
That's okay. So in terms of my career path, it was pretty smooth sailing, actually. I'm quite lucky. I think I've had amazing managers my entire career, both at Capital and at Fidelity. And so they've really supported me, sponsored me, made sure I was on the right programs and courses. Even to this day, I'm still learning, I'm still on courses. So I've had a really fortunate career path in that I didn't have many blockers. I know that's not the case for everybody. And I think also, if I look at my firm, do we have a lot of women on our floor? Yeah, we do. Our global head of trading is female. We've got a number. Our chief risk officer is female. We do have female representation, but I think we can do more. And I think what's really important, and I wish that I had this, is that in schools and at universities we knew more about the industry. And I think learning more about it, even things like what we're doing today, really getting a basic understanding of what is out there and what's available and what is possible for people is really important.
Yeah, great. Absolutely. 100% agree with you there. Thanks, Anisha. That's nice insight in there. What about yourself, Lushan? Has it been a nice, smooth progression?
Yes, I think overall, yes. I if I'm perfectly honest, during my career, at least at Mercer, I've never thought once, because of who I am, my gender, what I look like, that has impeded my progression at work. I think I completely echo what Anisha has just said. I think the financial industry is evolving so rapidly in terms of boosting diversity and inclusion. The opportunities are there for the younger generation, no matter who you are, what your background is, as long as you have the right capability and the right work ethic to rise as high as you would like in this industry. I think one thing I probably would highlight, and it's something I've constantly tell myself, is that sometimes maybe because it's natural to, I mean, females in particular, that we are potentially just by nature a bit more reticent, less likely to put a hand up, less likely to ask for opportunities or have those challenging, difficult conversations than perhaps our male counterpart. I mean, that's just from a personal perspective. I know that sometimes, you know, when it comes to performance review or promotions discussions or applying for new opportunities, I'm sometimes thinking to myself, well, am I good enough? Is there something I should be doing? And I have to constantly tell myself, don't think like that. You know, you need to be more confident, more you know, push yourself forward, more willing to accept new challenges, even though you know that you might be out of your comfort zone. And I think that's so important. Quite often these opportunities are not captured by women, or not necessarily because we're not good enough. It sometimes is because we might not, you know, we need to push ourselves to do it. And that's one thing one of the senior women I work with at the very beginning of my Mercer career told me very, very early on, is that you believe in yourself and just go for it. And I think that is so important to remember.
Brilliant, thanks, Lushan. Yeah, really good insight. I just thought it was nice to hear both of your takes on that, seeing as you both ladies, and even though these sessions are focused on slightly different kind of demographics as such, it's nice to hear from an inclusion and diversity perspective that when it comes to gender, that the financial services industry has definitely upped its game. And, you know, yes, things, as you said, Anisha, things could probably be improved, but it's nice that things aren't stuck in the dark ages. And I certainly know from some of the students that we've worked with in the past that go on to apprenticeship schemes or graduate schemes, looking at students from a wide range of backgrounds is something that a lot, especially investment management firms that I come across, have got a really good kind of handle on. So it's, you know, fantastic to hear that things have been good for you both. Okay, excellent, fantastic. So what I just want to do now is just take you through what we're going to cover off in this session. So, as I said, last week, which I'll recap on in a moment, in the last session, we spoke about the financial benefits or the financial returns for shareholders. And this session kind of carries on that theme of the benefits to shareholders, but we'll also look at the risks. So we're going to focus on what are known as annual general meetings or company meetings or company assemblies. We're going to look at those in terms of the benefits that they offer to shareholders. And we're also going to speak briefly about the risks that shareholders also face. And this will then bring us to the end of the equities chapter in the qualification. So this will conclude element 4. So just to recap on the benefits of share ownership that we covered last week in terms of the financial benefits, we spoke about 2 main financial benefits from owning shares. The first being capital gains. So just to remind you about that, capital gains is when you sell your shares for more than what you purchased them for, so they increase in value, and you basically make a profit on the sale of those shares. So that was the first financial return or benefit we spoke about. The second we spoke about were dividends, so the payments that are made potentially every half year to shareholders based on the profits of the company, and also the expectation and what the strategy of the company going forward would be. So those are paid out to shareholders on a more regular basis. And we also looked last week at how you calculate dividend yield, so how you measure that return in terms of the dividends based on the share price of those shares. So we went through the calculation last week, and you were able to calculate the dividend yields in a number of examples of companies that were given to you. So that does often come up in the exam. I would be surprised if that didn't. You didn't get a question on calculating dividend yields then. The other thing to point out about these 2 is they are not fixed. They are not set in stone. We spoke last week about the volatility in share prices and the fact that they are constantly going up and down, and obviously making a capital gain. I mean, Tristan last week spoke about the long-term view of investing in shares, and that really you're kind of looking for a 5 to 10 year time frame of which to iron out the volatility that you might see in share prices if you're looking to hang on to an investment. And also, as we said, dividends aren't guaranteed. If the company maybe hasn't performed particularly well in that year and the directors decide that it's not going to be possible, and again, Tristan last week spoke about a number of companies when he's been analysing companies to invest in, noticing the amount of companies that weren't paying dividends to their shareholders this year as a result of the COVID-19 pandemic. So that's just a recap on what we looked at in the previous week. So we're going to move on to other benefits for shareholders. So we're going to focus initially or primarily on the annual general meetings or AGMs. And there was a task for you to complete before this session, which was looking at a set of AGM resolutions from a Royal Bank of Scotland annual general meeting from a couple of years ago. So there are a few questions that we asked you around that. So I'm going to be quite cruel and quiz. I won't call you victims, Anisha and Lushan, but my volunteers, shall we say, my assistants for today. I'm going to ask you some of the questions. So when we're talking about this, and we'll consolidate some of this in the slides, obviously you can relate this back to the RBS exercise and the answers that you completed for that. So really the kind of first question that I want to put to Anisha and Lushan is, what is an annual general meeting? So what is an AGM? Who wants to kick off?
Shall I kick this one off then? So I guess so AGM is, well, as its name indicates, annual general meeting is a meeting that takes place on an annual basis between the management of the companies and the shareholders of the company. It's an opportunity for the management executives of the company to basically talk about recent performance. Why has the company performed as it has? What is current financial situation? How much money has it made effectively? How much dividend is it likely to pay to the underlying shareholders? And sort of, the business plan on the horizon. What is the management team going to do to grow the business going forward? And also at the AGM is an opportunity to vote on any decisions, or what they call resolutions, that the directors the shareholder need to vote on. So I mean, those can range from anything such as they want to have some new directors added to the board of the company, or how much should we pay the CEO of the company, to changes to the policies, some of the policies of the company. So a wide range of resolutions can be discussed and voted on by the shareholders and AGM.
Brilliant, thanks, Lushan. You've covered off a number of questions I was going to ask there.
Think of it as a parents' evening between those who own the company and those who run the company.
Yeah, absolutely. Yeah, indeed, absolutely. It's kind of school report time, isn't it? What have you done well? What haven't you done well? And answering to the shareholders on that front. You're absolutely right. Anisha, is there anything that you'd like to add to that?
No, I think that Lushan covered it really well, actually. I think it's an opportunity for shareholders to really hold the company to account, right? Like, how are they spending their money? How are they thinking about the direction of the company? What are they going to be doing over the coming year or years? And does it align with what they want as their own outcomes? So it's giving the shareholders a voice, I guess.
Yeah, absolutely. And we've spoken in previous sessions about the different types of business ownership structure, if you like, or types of businesses. And we spoke about private limited companies, public limited companies, and spoken about the reason why accounts have to be published and audited, and why you have to have AGMs is because of the public nature of those organisations and the need to be transparent and open, because that you can, as a member of the public, invest in a company by buying shares in them via a stock exchange. So very different. So obviously private limited companies aren't required to hold AGMs. It's only the public limited companies that would be required to do that, just as it is that only PLCs need to have their accounts audited for transparency purposes. Thanks, Lushan and Anisha. There's a couple of other things I wanted to say. Lushan, you said about resolutions. Can you kind of what is a resolution at a company meeting?
A resolution is essentially a decision or proposal from those running the company that have been put forward to the shareholders, those who own the company, and they want their approval effectively. So you know, these decisions need to receive approval from the shareholders before they can be implemented. I guess that's a layman's way of explaining. Resolution is just a fancy word.
Yeah, absolutely. Yeah, perfect. Thank you. Yeah, absolutely. Ultimately, as you say, it's things that shareholders need to make a decision on that require shareholder approval, as you say. They're absolutely right. Yeah, indeed. And Anisha, I mean, Lushan, you gave some examples. Sorry, Anisha, we'll come back to you in a sec. Lushan, you gave some examples of resolutions, like you said about maybe appointing a director, things like that. So, Anisha, to come back to you, what kind of why are these things important to shareholders? Why are things like the appointment of directors, maybe the removal of directors, these kind of things, why are they important for shareholders and for them to be able to vote on them?
Yeah, I think it goes back to making sure that the company is being run in line with the interests of all shareholders. And I think, you know, if we're seeing a company performing poorly, they should have the opportunity to say to the CEO or to the board of directors, you're not doing a good enough job and we won't reappoint you, or you're doing a great job and let's reappoint you. And it gives the power back to those who really own the company, right? The shareholders own the company. So that's the reason why it's important. I think it gives them a vote. It's knowing that you have a voice, and being able to say what they want to do otherwise. They make suggestions around who else they might want to appoint, or if they don't like the auditor and they don't like the, you know, how much that auditor cost, for example, well, if this company A was too expensive, let's suggest company B, and it gives the shareholders the opportunity to have a voice.
Yeah, absolutely. Yeah, absolutely indeed. And at the end of the day, the shareholders are the technical owners of the business, as you said. So ultimately, all of these decisions can have an impact on the value of their investment, can't they? So there is that kind of the financial impact that there might be on the shareholder in terms of the value of their investment, depending on the decisions that are made by the board. And so therefore, they want to have a say on it because it's in their interest financially. Or, as we know, some investors, they're not all about the monetary gains and all about the profits they can make from selling those shares. Some investors have a very kind of emotional attachment to the companies that they invest in for some reason or another, and are legitimately very interested in how the company is being run from a strategic and operational perspective. So yeah, excellent. Thanks, Anisha. Great answer. So we tend to have kind of what we would call ordinary resolutions in annual general meetings, which would be things like the appointment of directors or the approval of an auditor or something like that. But we also get something known as special resolutions. Can either of you describe what they are for me, please? Lushan and Anisha, which one of you would like to tell me a little bit about special resolutions? Lushan?
I can go first. I mean, special resolutions effectively are just special decisions, you know, decisions that are of a higher level of importance to the running of the company. It could range from something like they want to change the name of the company, they want to change where it's domiciled, for example, or they want to merge with another company or sell off a particular part of the company. So those are special decisions because they have, you know, significant impact on the future performance of the company.
Yeah, okay, yeah, right. So it's kind of anything that might make a material change to that company that needs special consideration, if you like, and not out of the something slightly out of the ordinary that needs to be determined, rather than kind of day-to-day things that might need to be signed off. It's yeah, like you say, special things like where the company is domiciled or takeovers, mergers. Yeah, absolutely. Good. Thank you both. So just to kind of consolidate a lot of what we've spoken about there. So in terms of shareholder benefits or shareholder rights, we'll speak about these in a little bit more detail. But one of the big benefits for shareholders as the owners of the company, as we just said, they have the right to attend company meetings. So AGM shareholders have that right to be able to go and attend these meetings, which as Lushan and Anisha said, are annual, they're once a year. Now, on the Google Classroom, there are some videos I posted on there of some examples of AGMs. Now, I'm not, some of them are quite long, as you can imagine, so I'm not saying that you should go and watch those unless you suffer from insomnia. But there's a couple, there's one on there from Allianz, German finance company. There's also Tesla, which is quite an interesting one. And there's there are timestamps for the Tesla video because it's about an hour and a half, 2 hours long. So you've got people like Elon Musk speaking to shareholders there, but you get to appreciate the scale of some of these meetings when they were held face to face in huge arenas, auditoriums. So some shareholders will attend in person. Sometimes they will attend virtually, like we're recording this. But they are on a grand scale because it gives that opportunity for all of the shareholders to hear from the board of directors. And it's the only time really in a year that shareholders get that opportunity. So it's important that they attend. So as a shareholder, you have the benefit and the right to attend those meetings. And as Lushan and Anisha spoke about, they also have the right to vote on what are called resolutions, these company matters that require shareholder approval. So they also have that right to vote. And finally, another benefit that we haven't mentioned, because it doesn't link into the AGM so much, but the other benefit is shareholders have something that's known as preemptive rights. So what that means is, as a shareholder, if the company decides that they want to raise capital by issuing more shares, so maybe through a rights issue, so after they've gone through the IPO and they've gone public and listed, the company, the directors can decide that they want to issue more shares in that company. Now, that might be a rights issue, that might be a bonus issue, whatever that might be. Now, the directors, the shareholders have the right of first refusal on those shares if they want them. So with a rights issue, the company, the board of directors can say to shareholders, right, we are going to issue X number of new shares, and you can buy another 2 shares for every one that you own, or something like that. And they will give them a discounted price for those shares. And so the shareholders have the right to take up that option of buying them if they want to, before they are then sold on if they don't require them. So that's what's known as preemptive rights of shareholders. So the ability to purchase new share offerings if they are made, if they are offered by the company to shareholders. They have to have that initial right to refuse those. Do either of you come across rights issues and things like that in what you do?
Yeah, I do. Yeah, so Fidelity invests in a lot of companies, and kind of talking about rights issues, we invest in those all the time. So if you don't do that, you dilute your holding, right? So if you own, say, 2% of the company, and then they issue new shares, and if you don't take them up, then you don't own 2% anymore. You're going to be factored down. So we do often take them up where it makes sense. If we're still feeling quite punchy about that company, we still want to own them, we think they're a good story for us, we will absolutely invest in those shares, because it will be, as you say, at a discount to market price. And actually, going back to your talk about the voting, Fidelity does, votes on many company meetings. We can't go in person, obviously, so we do it via a proxy, and we're able to send our votes in electronically, so we don't have to turn up in person.
Great, thanks, Anisha. You've preempted something that we'll cover as we.
Oh, sorry.
No, perfect. It just brings it up. Yeah, absolutely. We'll talk again about proxy voting in a little while. So yeah, it's really useful to know, as you say. So do you submit the votes to? So when you're working, how do you determine how you're going to vote? So who makes that decision?
Yeah, good question. So as you met Tristan last time out, he's a research analyst. And so if we're taking an example of a company that sits within his coverage, he'll know how he feels about that company. He'll be talking to fund managers within our business, and they'll be talking together and looking through those resolutions and saying, how do we feel about this particular director? How do we feel about the performance? How do we feel about the accounts, and how do we want to vote? And they will come together, they'll make a decision together, and then Fidelity votes with one voice. And we submit, we've got a proxy voting team, so don't ask me the ins and outs because I'm not sure, but their whole role is to really look across every single company that we invest in, understand when those AGMs are going to be coming up, and make sure we are prepared, right? We look at what those resolutions are going to be, and that we go and do our research and come up with a plan on how we're going to respond back to the company.
Excellent. So it's kind of by committee almost.
Yeah.
Yeah. Okay. Fantastic. Lushan, do you ever come across rights issues as well in your role?
Not necessarily in my current role, because as advisors to UK pension schemes, we advise on asset classes and individual funds. We don't advise on individual companies. But when I did my internship in investment bank in 2008, I was in the equity capital markets. So certainly came across rights issues, IPOs, a lot during my 3 months there. So it was a very interesting time, because, and I mean, I'm sure those the students won't remember because they'll be quite young, but it was right in the middle of the global financial crisis, when things were slightly in a meltdown mode, and we saw so many companies, especially banks, issuing new shares. And the reason they were doing that, because they were rapidly running out of cash to cover the positions they had that were affected by the financial crisis. And one of the main ways to obtain cash is to issue new shares to investors. And as Anisha said, then the existing investors will have a decision to make whether they take part in the rights issue to buy the new shares on offer, or do they retain current shareholdings, which will mean that their stake in the company will be diluted as a result. So that was so we do see rights issue quite often when financial markets in a distress situation.
Yeah, sure. And have either of you come across bonus issues or scrip issues?
Yeah, we do. So in particular in the UK, we see that, when you get a dividend, you get the option to take it up as cash, stock, and then you get the bonus. So there is a number of decisions to be made by our investment teams around how we think about that. So yeah, we do see it, but I guess there's different scenarios for each company, so we take them on a case-by-case basis. There isn't really a kind of a decision to make at a company-wide level. We do it every time we see one come through.
Okay, brilliant. Thank you both very much for that. It's really useful to get an insight into what goes on from people that work in and encounter these things. So yeah, very interesting. Thank you. And just to kind of consolidate what we were talking about specifically about AGMs. So as we said, it's kind of the only opportunity in the year. Sorry, we'll go back there. It's kind of the only opportunity in the year for the shareholders to meet face to face or virtually with and hear from the executives or the board of directors. Sometimes sometimes the executives or the directors are referred to as the C-suite. So your CEOs, your chief executive officers, CFO, chief financial officer, COO, chief operating officer, whatever that might be. You sometimes hear the term C-suite used to refer to the board. But yeah, the meeting is that chance for the owners of the company, the shareholders, to get information about company performance, how they've done over the last year, but also strategically going forward, what the objectives are going to be and how they are looking to achieve those and where they see the company moving. And then as Lushan and Anisha have both spoken about the resolutions, you get those issues that are raised to shareholders where shareholders have to make a decision one way or the other on some of those. So as we spoke about ordinary resolutions like voting, approving company directors or approving auditors, we also spoke about special resolutions that require shareholders to vote on more, shall we say, material issues to the company, maybe how it's structured, takeovers, mergers, and things like that. So when you've gone through the RBS resolutions, you will have seen a number of examples of some of those that we've already mentioned that have come up in that document. So you can see in that document the resolutions that RBS have put to shareholders, and also how shareholders have voted. So as we said, shareholders vote on these resolutions. It might be a simple yes, no, and then action is taken as per the votes of those shareholders. So just kind of consolidating everything that we've spoken there about AGMs, and just a few more points. As we said, they occur once a year, and it's that opportunity for shareholders and executives to come together, for shareholders to question the way the company is being run and what the plans are for the future. And as we said, these resolutions that are put to shareholders, those shareholders can make those decisions. Now, as we said, you've got ordinary resolutions, which are these kind of more standard things that shareholders can vote on. And generally at AGMs, it requires a simple majority of shareholders to vote in favour for it to be passed. So if it's to approve a company director, 51% of the shareholders for that ordinary resolution will need to vote a yes for that person to be approved and appointed to the board. For special resolutions, because they are to do with kind of more, should we say, significant issues or things, then that requires a larger percentage of shareholders to vote in favour. So you need 75% of shareholders to vote in favour to pass a special resolution at a company meeting. And Anisha really nicely tied in the idea of proxy voting, where if a shareholder can't be present at the meeting to vote in person, they can vote, appoint someone on their behalf to vote for them. So you can do this in general elections or local elections yourself. You can appoint a proxy voter. So the same applies in company meetings. Someone can vote on your behalf as the shareholder. So that nicely kind of summarises annual general meetings and some of those benefits that shareholders can enjoy above the financial returns. So as we said, the ability to attend meetings, vote on company matters, but also these preemptive rights for shareholders in terms of new share issues by the company. Okay, so the last thing that we're going to talk about is risks to shareholders. So we've spoken a lot about the benefits for shareholders, but what risks do shares have for those that own them? So Anisha, Lushan, any takers on potential risks to shareholders that may come up? Anisha, did you want to?
Yeah, okay. I'll go first. Probably two that I can think of that have probably been really relevant, particularly in the last sort of year with COVID, has been price risk and liquidity risk. So if we think about when we saw COVID kind of come through in March, we saw markets tank. We saw them fall off a cliff because people were nervous and worried about the future. And I think when we saw that happen, we saw the price of stocks fall, and some sectors didn't, but many sectors did. And so you get market risk, which is basically, you lose money on the price of the company. And the other one would be liquidity risk. So in terms of if there aren't enough buyers in the market, and if you want to sell your shares, you might not find someone to buy it. So you have a problem from a liquidity perspective. There just isn't enough volume in the market. So those are two that I think we saw quite prevalent last year in March.
Great, thanks, Anisha. Lushan, are there any other risks that you can think of that you might want to add to that?
Yeah, I think Anisha certainly highlighted the two most important risks. I guess another one that's perhaps a newer one that's become more on the spotlight in recent years is reputational risk. A lot of the investors that own shares are well-known entities, especially some of the clients I advise, they are pension schemes of well-known companies. So if it transpired they own shares in the company that was dodgy, doing bad things, it reflects very badly upon them and could potentially even have financial implications for the investors themselves. I mean, a recent fairly famous example is a Church of England pension scheme investing in payday loans. That was deemed as unethical. For those of you who might not be aware, Church of England pension scheme actually has a very high level of sort of engagement in terms of ethical investment. They're very keen to make sure that the companies and businesses they invest in take things like ethical considerations really, really seriously. So for them for it to come to the public domain that they actually had an investment through one of the funds into payday loans was a bit of embarrassment, I suppose you could see it that way. So that definitely resulted in some reputational damage to the Church of England pension scheme. So we definitely see an increasing amount of focus on that type of risk, and making sure the companies, the businesses that the investors investing don't have the potential to cause reputational damage.
Yeah, so good. I mean, that's not on the slide. That's not even included on there. But like you say, it's something recent. I do remember some time ago, several local authorities in the UK, several local councils that had money invested in Icelandic banks, and the Icelandic banks got into financial trouble and caused a few issues for them. So yeah, that reputational risk is an important risk for shareholders, especially for the types of companies that you or the types of funds that you look after and work with. So yeah, it's a really good one. Both you've given some excellent examples there. So just to kind of bring that all together, Anisha spoke about the price risk, about the fact that the share price in the company can decrease as a result maybe of market conditions or something that has happened with the company that has caused the price to fall. And I've got BP as an example up there. Again, probably students might be too young to remember this, but I mean, oil energy companies often come under quite a lot of scrutiny, don't they? And if you remember, BP were responsible for quite a major oil leak in the Mexican Gulf, which was I think it was a film about it. Mark Wahlberg, Deepwater Horizon or something like that, the name of the rig. We also spoken about Volkswagen when the diesel emissions scandal and the falsifying diesel emissions there again had an impact on the share price of the company. So yes, it might be that the falling price of the shares can have that impact on shareholders, and again that might have, we're bringing it back to financial returns, that might have an impact in terms of the capital gains and even potentially from a dividends perspective if the company suffers as a result. So yes, price risk is a big one. Anisha also mentioned liquidity risk. So the fact that when we talk about liquidity, we're talking about how easy it is to turn something into cash. So if you've got any asset, whether it's a house or jewelry, whatever it might be, if you want to turn that into money, in other words, sell it, liquidity refers to the ease at which you can do that. So the more liquid something is, the easier it is to turn into cash. So shares may be difficult to sell, especially if maybe you have a company that has done something and it's affecting their reputation, and everyone starts to sell those shares, and suddenly you think, right, I need to sell them, but unfortunately no one wants to buy them because everyone's getting rid of them and because they're not desired. So sometimes it can be difficult to sell your shares quickly, and therefore that might impact what the amount you might receive when you sell them off. Also, we've got the whole idea of issuer risk, again, that in the current climate, once we come out of COVID, we hear a lot now about the economic consequences of the pandemic. We've seen a number of companies already that have gone under, some well-established companies. I mean, I've got a couple of examples there that were victims after the financial crisis in 2008, as Lushan spoke about. So when a company gets to that point where they basically go under and can no longer trade, then obviously shareholders potentially could lose their investment. Now, one of the things that we have spoken about previously is when a company gets into that situation, shareholders are at the bottom of the pile when it comes to any money that's left once everything's been paid off. So if there's any money left, it'll be shareholders at the bottom of the pile that will receive something back, and it'll be the likes of bondholders or maybe suppliers and people that the company owes money to that will get their money back before that, if there's anything left for them to have. And the only other thing to point out is that if you're buying shares in companies in overseas, and maybe you are buying them in different currencies from your domestic currency, you have to kind of think about potential price move or currency price movements that may also present a risk to you as the shareholder. That can be a positive, doesn't have to be a negative, but obviously that can impact on the value of your investment. Are there anything, ladies, is there anything else that you wanted to talk about from a risk perspective, or do you think that covers everything? We've got Lushan spoke about the reputational risk as something we haven't got up there. Any other types of risk that we've not spoken about up there that spring to mind? Or are you all okay? You're both okay with that? Okay. Excellent. Okay, fantastic. Right, so that's everything that we need to cover for the session. For those of you on the Google Classroom, please do go into the materials there. There's a multiple choice quiz for you to look at there, just to test your knowledge about the content that we've covered off today. And I would just like to say a huge thank you to Anisha and Lushan for joining us for the session. It's been a privilege to have you both here. Thank you both for your insight and your input, and it's been really great to hear about your careers and how you got to where you are and what you currently do. So thank you both very much.
You're welcome. It's a pleasure.
Yeah, thank you for having us.
Thank you. No problem at all. Excellent. Right, we shall say goodbye to you all. Thanks very much. Take care. Bye.